In the consumer packaged goods sector, standard industry logic assumes that top-line revenue growth is the ultimate metric of a brand's health. That's why the Honest Company's Q1 2026 earnings report initially looked like a disaster. The headline revealed a 19.7%. For many of these brands, scaling through DTC eventually erodes operating margins, absorbing escalating freight, direct ship fulfillment, and digital customer acquisition costs. Management introduced Transformation 2.0 as a decisive exit strategy from this margin trap. The strategy rests on a difficult trade-off, that to structurally raise gross margins, the company must be willing to walk away from nearly 20% of its reported revenue. This restructuring sets the stage for a broader shift in CPG strategy, moving away from capital-intensive DTC scale back toward the leverage found in wholesale retail. A look at the Q1 revenue waterfall reveals where that money went. We start with the 2025 baseline of $97.25 million. The first deduction was the exit from the apparel category, a low-margin business creating drag on the balance sheet. Next, they exited operations in Canada, eliminating logistical costs of serving a separate market. Then came the most significant cut, shutting down Honest.com direct ship fulfillment, moving that volume entirely to retail and third-party e-commerce. These non-strategic exits accounted for roughly 22% of the company's historical revenue base. Removing these specific, high-friction categories structurally elevated the company's gross margin floor from the mid-30s into the low 40s. This lean model works because it eliminates the freight costs, SG&A overhead, and third-party service fees associated with the direct ship apparel business. Mathematically, losing 20% of top-line revenue becomes an advantage when that revenue was actively diluting the enterprise's profitability. To see how the brand is actually performing with consumers, we have to look at organic revenue, the measure of the business after the strategic exits are stripped away. On this organic basis, the remaining core business didn't just survive the restructuring, it actually grew by 3.9%. This growth is fueled almost entirely by the wipes and baby personal care platforms. Honest is growing at a multiple of its peers. While the industry saw growth between 2 and 5%, Honest's core expanded by 16 to 25%. The adult flushable wipes category is a standout performer, growing consumption by over 200%. Behind the headline contraction, the product market fit for Honest's remaining portfolio is expanding much faster than the macro environment. This double-digit growth is happening despite the pressure of broader economic inflation, suggesting a high degree of brand loyalty. This is driven by the clean CPG standard, which creates a level of price inelasticity among the brand's core customers. Consumers are often willing to pay a premium for specific formulation standards, like wipes made without harsh preservatives, like sodium benzoate. These standards allow the brand to expand into different demographics, successfully reaching both parents with babies and households with no children at all. These ingredient standards act as an economic moat, allowing the brand to maintain premium retail pricing even as input costs fluctuate. However, this expansion is tempered by the diaper category, which remains the most difficult segment of the portfolio. In Q1, Honest's diaper consumption fell by 9.6%. This reflects a broader industry trend, as the domestic diaper market fell by 1% while navigating severe deflationary pressure. Honest is fighting an uphill battle against legacy giants that dominate the category with massive economies of scale and aggressive promotional pricing. The brand also faced a localized headwind, the loss of shelf space for its gender-neutral prints at a major brick-and-mortar retailer. While a 9.6% drop is significant, it is a notable stabilization from the 18.3% contraction the company saw in the previous quarter. Currently, the diaper business is a capital-intensive, low-margin environment that acts as a drag on the company's overall margin average. If diapers are such a drag on margins, it raises the question of why they weren't cut alongside the apparel line. In the broader CPG strategy, diapers act as the primary entry point for capturing the attention of first-time parents. The goal is to use the diaper for initial acquisition, then cross-sell the household on higher-margin wipes and personal care products for the long term. Licensing partnerships help accelerate this transition, with Disney and Pixar-themed bath and body collections designed to keep parents in the ecosystem as their children grow. A healthy CPG portfolio relies on this balance, using high-volume acquisition products to feed a high-margin retention engine. Beyond individual product categories, the enterprise's underlying health is anchored in its revised operational architecture. That record 43.5% gross margin is the result of both a refined product mix and a total overhaul of the company's supply chain architecture. By consolidating warehouse footprints and securing more favorable freight costs, management has structurally lowered the cost of doing business. These efficiencies allow the brand to absorb headwinds like rising tariffs without sacrificing its newfound profitability. The company has effectively exited the era of structural complexity and entered a phase of structural leverage. Looking forward, management has reaffirmed its guidance for fiscal year 2026, establishing the new financial floor for the company. The targets include a high teens drop in reported revenue, organic growth between 4 and 6%, and an adjusted EBITDA target of $20 to $23 million. Because of the heavy restructuring charges from Transformation 2.0, the company's current PE ratio is still negative. However, looking at the price-to-sales multiple, Honest is currently trading at approximately 1.2x. That 1.2x multiple is significantly lower than structurally profitable peers like ELF Beauty, which trades closer to 2.29x. The market is currently pricing Honest based on its historical volatility, even as its wholesale margin floor is becoming structurally secured.